All right, let's talk about ManCredit or MCFL. What's so interesting about them right now? Well, as of February 2026, they're sitting at what you'd call a huge strategic inflection point. And the whole story really boils down to one thing: their unique competitive advantage, something they're calling the diamond moat.
So on the surface, things look good. Their fundamental state is rated as strong. But the real headline here, the thing you've got to pay attention to, is that phrase, strategic inflection point. That's not just jargon. It means the company is making a major shift in how it operates. So, what exactly is this big change? Let's get into it.
Okay, so here's the pivot in a nutshell. They've completely walked away from their old business, that was industrial leasing, and are now going all in on retail credit. We're talking about loans for gold, for small and medium enterprises, and loans against property. And the engine behind all this? It's institutional leverage. This isn't just a small tweak, it's a total rewrite of their business model. And this brings us to the heart of their new strategy, what they're calling the diamond moat. It's a pretty cool concept, actually. They're lending against diamond ornaments. Now, why diamonds? Well, it plays perfectly into the chairman's deep roots in the jewelry business. This carves out a really juicy, high-yield niche that almost no one else is touching. And here's the kicker. Bigger players, like the standard gold loan companies, stay away because appraising diamonds is incredibly complex. That complexity is the moat.
So that's the strategy. But is it working? Is anyone buying it? Well, that's where we get into the bull case. And it starts with some serious validation from the big institutions. Crystal reaffirmed their BBB/stable rating. And right after that, boom, their credit capacity doubled from 200 crore rupees to 400 crore. That's a 100% increase. What that really means is they now have a ton of dry powder, capital ready to be deployed, to really hit the gas on their expansion.
And they're not just sitting on that cash. The growth we're seeing isn't just on the balance sheet. It's on the map. They're pushing out from their home base in Mumbai and executing this really smart cluster-based expansion. They're strategically planting flags in these high-demand Tier 2 and Tier 3 markets, places like Rajasthan and Gujarat, looking to tap into a completely new wave of customers.
But here's the question you should be asking. Is all this expansion actually efficient? Or are they just burning cash? Well, the numbers seem to say they're being pretty smart about it. Their capital efficiency looks robust. You can see their return on assets, or ROA, is consistently staying above that 4.5% benchmark. And when you tack on a 30% historical profit after tax growth, it really does suggest they've got a disciplined, scalable plan in place.
Okay, so that's the bull story. Sounds pretty good, right? But to get the full picture, we have to look at the other side, the bear case. And it really boils down to three main risks we need to keep an eye on. First, all this aggressive expansion, it's costing them. Operating costs are way up. Second, while they are expanding, they're still heavily concentrated in Western India, which is a big risk. And third, a part of their loan book, the unsecured MSME loans, is sensitive. It could get shaky if the economy turns.
So you've got the bull case and the bear case. Where does that leave us? Well, when you put it all together, the verdict is that MCFL looks like an emerging compounder. What does that mean? It's basically a bet on the financialization of semi-urban India, bringing more financial products to these growing areas. They've got the support of a really strong capital adequacy ratio, over 40%, and a valuation that, for now, seems to make sense given their growth trajectory. The next big test, it's just around the corner, the February 9th earnings report. Everyone's going to be watching to see if this whole new strategy is actually growing their assets under management. So the big question we're all left with is this: will that diamond moat be strong enough to protect them and drive growth, or will the high costs of their expansion sink the ship? That's what we'll be watching.